Okay, if you've been watching the market lately, you know the feeling, right? We've seen quite a dip, roughly a 7,000 to 8,000 point correction, falling from around 169,000 down to, what, 162, 163,000. And for the past week, it's just felt like this continuous downward pressure. It's heavy. So our mission today really is to figure out, using the technicals, using the flow data we have, is this just a healthy pause, a pullback? Or are we actually starting down the past more serious, longer-term downtrend? Let's try and unpack that, starting with that key difference, pullback versus correction.
Exactly. And getting that distinction right is absolutely vital because it really dictates your entire strategy. The fundamental rule, first thing we need to get straight is that the main day structure is currently intact. It hasn't broken.
Yeah.
And until that structure breaks, technically speaking, the market is just in a pullback, not a
Oh,
serious correction.
a pullback is just it's volatility, maybe some profit taking, but it happens within a larger uptrend. Okay, we hear day structure thrown around a lot. For listeners, maybe those familiar with basic charts, how should they kind of picture this structure holding?
Right. Think of it like the foundation of a building. The day structure is built on where most of the trading volume has happened recently. And there's a hierarchy, you see. You've got 15-minute charts, hourly charts, daily, weekly, monthly. Now, a correction on a 15-minute chart, that doesn't mean the whole market's correcting. That's just noise sometimes. The day and monthly charts, those are the parents. The smaller time frames are the children. Right now, the parent structure is holding firm.
Okay, so if the parent structure is okay, where's the actual line in the sand? What's that specific level where this healthy pullback flips into a confirmed break?
That critical level comes from volume profile analysis. We look at the point of control or maybe the value area low. That's where the market's gravity is, essentially. And that specific level right now is 158,000. If the index closes below 158,000, that is the precise moment the day structure is confirmed broken. And that's when we say, okay, a serious technical correction has started.
And if 158K fails, what happens next? How do analysts then sort of classify how deep the trouble might be?
We immediately turn to exponential moving averages, EMAs. They help gauge the severity. So breaking the day structure usually sends the price towards the 21 EMA.
Yeah.
That signals a relatively shallow correction. If that doesn't hold, we look down towards a 44 EMA. That suggests more of a middle type correction. Now, if the selling is really intense and we hit the 100 or worse, the 200 EMA, well, then we're in deep trouble. That indicates a major deep correction, a serious change in market personality.
Makes sense.
And, this clarity on structure brings us straight to what might be the most vital piece of advice right now. Cash is king. The current situation really demands keeping as much cash ready as possible. Why? Because the biggest profits, the real opportunities, they often come right after the reversal happens, when the market finds its bottom.
Yeah.
And you absolutely need capital ready to deploy when that confirmation arrives.
That's really good advice. Don't jump the gun and use up all your buying power too soon. Okay, so if the day structure is holding for now, let's look at the other technical health checks. What are the other indicators telling us about the long-term trend's momentum?
Well, we can start with the RSI, the Relative Strength Index. It measures the speed and change of price movements, basically telling us if things are overbought or oversold. The day RSI, it started this pullback way up high, around 88. Classic overbought territory. It's since come down, normalized a bit, and is now hovering near 60.
Is there a magic number for RSI in this context?
The key rule is pretty simple. As long as that day RSI stays above 50, the market is still considered to be in an uptrend or at worst, just a strong pullback phase. It's definitely not a downtrend yet. 60 is actually quite a healthy level after the kind of run we've had.
Okay. What about other momentum systems, like Renko?
All right, Renko charts are interesting because they filter out time, focusing only on price movement using these bricks. Our daily Renko chart, it has shown 2 red bricks recently, indicating selling pressure. But the must-trend indicator that often goes with it is quite strict. It actually needs a 3rd red brick to give an official exit signal. So right now, technically, it's still signaling hold. Plus, the MACD indicator, that's the moving average convergence divergence, which also tracks momentum, is holding up pretty strong on the higher time frames, like weekly and monthly.
Now, the point and figure analysis, the PNF, I think this is where it gets really interesting because PNF often cuts through a lot of that short-term noise, doesn't it?
It really does. PNF is fantastic for that. It ignores time completely, only plotting significant price reversals. It's often seen as, well, maybe the most reliable system for judging the health of a correction. And if you look at the PNF monthly chart, that's like the ultimate parent trend, it shows absolutely no correction has even started. None. It remains strongly bullish. And that provides crucial context for everything else. Yes, the weekly and daily P&F charts do show pullbacks happening, but the big picture, the main direction, still looks favorable because that monthly P&F structure is so solid that kids might be acting up, but the parent is stable.
That's a really powerful way to frame it. Helps manage the fear, you know? It's contained volatility, not necessarily a systemic breakdown yet. Okay, let's pivot a bit. Away from the charts, let's talk cash flow. Technicals are one piece, but who is actually doing the selling and what's the thinking behind it?
Well, the biggest seller by volume recently has been the insurance sector. They've moved uh, well over $50 million out. But importantly, this doesn't look like panic selling. It's more like classic profit booking, maybe some asset switching. You have to remember, they were huge buyers way back when the index was down at 40,000.
Yeah.
So they're just strategically locking in some very substantial gains near the recent market highs. Makes sense for them.
Right, taking profits off the table. But there's other selling too.
Yes, the selling that's perhaps more, let's say, structurally concerning is coming from foreign corporates. They've been significant net sellers. The analysis mentioned something like 826 million out in just 9 days.
Yeah.
And that's part of a much larger historical selling trend from them.
Okay, so if we connect the dots, why are they heading for the exits while, as we'll discuss, local confidence seems higher? What's the bigger picture there?
The core reasons seem to be structural barriers. Primarily, it's about taxes. The tax rates can be quite severe, potentially up to 50% at the individual level, mentioned in some contexts. And there's also maybe a less rosy economic outlook perception from their side. We're seeing official GDP forecasts trimmed slightly, down from 2.8% to 2.6%. So foreign players might see these high taxes as a real barrier to sustainable long-term profits here. It just makes it easier for them to take their existing profits and deploy capital elsewhere rather than navigate the regulatory environment.
That's a real split, isn't it? You've got international capital maybe spooked by the regulations and taxes, but then local individuals and mutual funds are the ones consistently stepping in, buying on the dip, absorbing that supply.
Exactly. It's quite the dichotomy. The local players are showing a strong belief in the value proposition at these current index levels. They seem to view this pullback as a buying opportunity, whereas the foreign entities perhaps see it as confirmation that the structural barriers are just too high for their liking.
Interesting. And speaking of external factors, what about that news regarding the IMF asking for clarity on an $11 billion trade data gap from past years? Did that headline risk contribute to the recent slide?
The analyst consensus seems to be probably not much, actually. They largely view it as a technical accounting issue, maybe a data entry error from previous years. It's not expected to really impact current investment flows or market sentiment directly. It's important not to let that kind of administrative news fuel fear during a technical pullback.
Right, don't get sidetracked by headlines that aren't driving the core market action.
Exactly. However, we always need to keep an eye on potential high-impact external factors, things like security developments or major political news like whatever might come around November 9th. These external events, they probably account for about, say, 25% of market movements. And negative news can absolutely exploit a vulnerable technical pullback. It can push a pullback into a full correction, even if the charts weren't quite there yet on their own.
Okay, so the big picture is pullback, not correction yet. Stay liquid, watch 158,000. And be aware of external risks. Given that local players are buying this dip, let's drill down. Where exactly might they be seeing value? Let's look at 3 specific stocks mentioned in the analysis that seem to have actionable strategies right now. Let's start with MECTR, MacDor.
Okay, MECTR. It has some good things going for it fundamentally. Decent recent results, and they're expanding their manufacturing capacity, specifically in injections. That's a sign of a growing business. Technically, it's interesting. It's trading right in that zone between its 200-day simple moving average and its 200-day exponential moving average. That's often a consolidation area. The strategy laid out is pretty clear. There's a defined buying zone between 370 and 385. But crucially, you need a very strict stop loss. If it closes below 360, you're out. That protects against a breakdown from that consolidation. If it holds, the potential targets identified are 402, then the 417, 418 area, and maybe even up towards 440 longer term.
Okay, disciplined entry, strict stop. Next up, PRL, Pakistan Refinery Ltd. This one caught my eye because it retested a really significant historical level.
Yes, PRL. It came back down and retested that critical 35.00 level, which has been major monthly resistance in the past. There's a huge psychological and technical point. So the accumulation zone suggested is just above that, between 36.0000 and 37.50. And again, a strict stop loss is essential here. below 35.00 on a closing basis. You don't want to be holding if that key level fails.
And the Renko chart looked positive for PRL.
It did. The Renko analysis suggests the correction there might actually be complete already. The stock found support right on its 44 EMA, which is often a good sign. It looks like a healthy retest and reset.
Okay, so what are the targets for PRL?
The immediate targets look like 40.00 and then 42.50, but the really interesting part is the longer-term potential. If, and it's a big if, PRL can break above and hold 45.00 on a monthly closing basis, then the analysis points to much higher potential targets, 52.00, 60.00, and even way up at 81.00. And this is where that magic line concept comes in for PRL.
Ah, yes, the magic line. How does that apply here?
It's about conviction and timing. The strategy suggests buying your first bit now in that 36-37 zone. But the second, potentially larger by the magic line entry, is conditional. It's triggered if the RSI climbs back up to 60. And for PRL, the chart work indicates that an RSI of 60 corresponds pretty closely to a price of 41.00. So that 41.00 level becomes your high conviction entry point. It suggests the momentum is really picking up, potentially strong enough to challenge those bigger resistance levels later on.
Interesting conditional entry. Okay, finally, let's talk about TGL, Telecard. It seems to have strong daily momentum, but the strategy is also conditional, right?
That's right. Telecard's daily man CD indicator is showing dark green, which signals really strong momentum after it's been a long time consolidating. That's usually a positive sign. However, the buying strategy here requires a bit of patience. It's conditional because the stock needs to prove it can sustain itself above a key resistance level, 11.00. That 11.00 mark is a big psychological barrier. It's been a triple top area, meaning it's failed there multiple times before. Heavy resistance.
So you wait for the break and hold above 11.00 before jumping in.
Exactly. You need confirmation it can stay above 11.00. The stop loss is placed below 9900. If it does successfully break and hold above 11.0, then the confirmed targets are 12.00, then 13.15, and potentially a move up towards 15.00. That conditional entry is really important to avoid getting caught in a false breakout or a whipsaw right at that critical resistance point.
Okay, let's try and pull this all together then. The main takeaway seems pretty clear. The market is technically undergoing a pullback, manageable volatility within the bigger uptrend. It's not, as of now, a confirmed serious correction, but managing your cash, keeping capital liquid and ready seems absolutely crucial right now.
Precisely.
So what does this really mean for you, the listener, the learner?
Well, the technical picture and the flow data, they tell a fairly consistent story. You've got foreign entities maybe a bit nervous about the tax situation, so they're selling, but local players, individuals, mutual funds, they seem to see real value at these prices. They're buying the dips. And this whole situation really reinforces that cash is king idea right now. You want to be ready for when that inevitable reversal finally confirms itself.
And maybe I can leave you with one final provocative thought. Something that puts global financial pressures into a bit more context. Look beyond equities for a moment. What's happening in the gold market's fascinating. Technical barriers, resistance levels, they're being completely ignored right now. The price of gold just keeps climbing relentlessly.
And that's not typical retail buying. No, not primarily. This surge appears to be driven heavily by state actors, specifically countries like Russia and China. They're reportedly making massive gold purchases, sometimes directly from U.S. reserves or markets. And the suggestion is their long-term goal isn't just diversification. It might be part of a strategy to, well, slowly destabilize the U.S. dollar's dominance and bolster their own currencies or reserves as a hedge. What you're seeing is potentially a geopolitical battle between superpowers playing out right there in the commodity markets. And that kind of state-level buying power can just overwhelm traditional technical signals.
Wow. That's definitely a bigger picture context to keep in mind when we see volatility anywhere. So remember, everyone, the ultimate goal here is profitability. Whether that comes from carefully buying during this pullback or making disciplined exits, always think about securing those profits. You know, that philosophy of getting Rs 50 or Rs 100 per share safely in your pocket, rather than just seeing small paper gains evaporate. You now have the key levels, that 158,000 on the index, the specific stock zones, and the broader context from the flows to help you decide on your next move.